All right. What's up, everybody? I have a very special guest today. I have Nick from Reventure Consulting. You might have heard of him. He has a pretty big YouTube channel all about real estate data and analytics. And I'm sure a lot of you guys have already heard of him. If you haven't, go ahead and subscribe to his channel. He's pretty bearish on the housing market, and we're going to get into our top 10 predictions of what we think is going to happen in the 2022 housing market, and we are starting right now. And by the way, if you have any questions, you can save them till later, and we'll take some questions over after the end, after we go through our predictions. So just hold off on the questions, and we'll jump into those later on.
Yeah.
All right.
Before we get into it, Michael, just want to say, excited to be on here. Thank you for reaching out to me. Many people who work in real estate and who have YouTube channels do not like me and post negative videos. So it was nice to see someone actually reach out to me and make a positive connection. So I'm excited to do this video and talk about our predictions.
Absolutely. Well, after watching some of your videos, I mean, you clearly have the data. You have, and the data doesn't lie. You can say whatever you want, but whenever you're looking at the analytics of something, that tells the real picture of what's really happening. So
that's right.
I respect that, and I'm happy to have you on here as a guest.
Yes.
So thanks for coming on, Nick.
Of course.
All right. So why don't you go ahead and give us your first housing market prediction of 2022?
Yeah. So, the market's crazy right now. And I think the big news that a lot of people are talking about, I've been talking about on my channel, is mortgage rates. And I think everyone knew that mortgage rates were going to go up in 2022 with tightening Fed policy and higher inflation. But I don't think people expected, to already be at a 3.6 to 3.7% 30-year fixed mortgage rate. And that's really very fast pushing up what the payment is when someone buys a house. And so, one of my key predictions is I think these higher mortgage rates are really going to tank both regular home buyer demand as well as investor demand in the housing market. And it's important to talk about it from both of those perspectives because, clearly with the regular home buyer, it's obvious, right? If the mortgage rate goes from 3.1 to 3.7 or even to 4 or 4.5, that monthly payment's getting a lot higher. Maybe their wages went up a bit, but not that much. So that's going to constrain what a regular home buyer can afford and what they qualify for. So I think we're going to see reduction in regular home buyer demand, as well as investor demand, because I think even though investors buying cash, oftentimes, it's often they have a hurdle rate that's influenced by interest rates. And so with the higher interest rate regime that we're seeing right now, investors are going to be kind of incentivized to potentially buy bonds or other assets instead of real estate. And so I think these higher mortgage rates, in the grand scheme of things, can be very problematic for today's housing market in 2022. And it's going to lead to home price declines this year in certain parts of the country, which we can talk about a little later. The parts of the country I think are going to see big price declines.
Yeah, I agree with you there. And that actually leads into my first prediction, which is that cash buyers are still going to have the upper hand in 2022 due to these higher rates, because everybody's going to be less incentivized to go ahead and get a mortgage now that it's going to cost a lot more. But especially if the housing prices keep going up with those rising mortgage rates, that's going to be a problem for everybody. Like you said, with affordability, it's going to be tough.
Yeah, I agree. I mean, I think it really depends. Clearly the cash buyer has an advantage over the regular buyer with higher mortgage rates. I think it probably depends on the type of cash buyer they are. Are they an investor who's buying for cash flow and yield? Or are they just a wealthy buyer with tons of money who doesn't care? You have a lot of those people in California, they just don't care. So they'll just pay whatever they need to pay. I feel like it kind of depends on what who the cash buyer is. I mean, out of curiosity, you're based in Florida, right? So when you see cash buyers in Florida or in Miami, who are they? Are they people who are buying for yield, or are they just buying to buy something and parking cash?
Yeah, almost all the time, I would say it's usually somebody looking to park the cash. In the past, it was always out of state or even out of country investors just looking to park their money somewhere into a piece of property that they can come and use from time to time. Most of the time it would sit vacant. but in the meantime, maybe they might rent it out as a vacation rental, or some of them, they just have so much cash and they let it sit empty for as long as they want, and then they'll come use it as they please. But that's typically what I've seen for most cash buyers.
Hmm.
Most of the smarter investors will usually, get that leverage and, get that bank loan because obviously they can make their cash go further.
Sure. That's interesting feedback.
Yeah. So what's your next prediction for 2022, Nick?
All right, my next prediction here, and it's a good segue because you mentioned how like cash buyers are buying up homes, and when you said they sit vacant, right? Like that, I think is a big sticking point for a lot of people. I don't think anyone likes that when a cash buyer comes in and a home sits vacant, which I'm sure we're seeing a lot of. But one thing that does help alleviate that burden is more new home building, and we're going to see a ton of new home building in 2022. And this is a topic I think there's a lot of misinformation on in the mainstream narrative. Like all we ever hear, and I'm sure, stop me if you've heard this, we're 4 to 5 million homes short in America. Like that just gets repeated
Yes.
over and over and over again. And while it's true that we had a period probably from about '08 to 2016 where building dipped, since then it's come back pretty strong. And actually in 2021, we had 1.35 million homes completed in America. And I think we're going to have 1.5 million in 2022 based off how good and how big the housing starts were last year. We had a lot of housing starts, 1.6 million in 2021. I think we're going to have about 1.5 million completions in 2022. Why is it less than housing starts? Well, because we have some of these supply chain disruptions and labor shortages, which mean that builders can't always finish the homes that they start. But I think the good news that no matter if you're a housing market bear or bull, I think everyone sees more home building as a positive for the sustainability of the U.S. housing market in the long run. So we're going to see a big surge in home building in 2022, specifically in certain markets, which is the key thing to understand. A lot of people look at the shortage supposedly in the building as like a nationwide thing, but it's really market by market. And there's been certain cities where the home building boom over the last 2 years has just been insane, like Austin, Texas, Phoenix, Nashville. We have a lot of places in the South and in the mountain regions, Denver, Boise, where there's been a big surge in building in just a short amount of time. We're going to see many of those homes delivered in 2022, which is going to add needed inventory to those markets and push prices down. And so that's going to be a great thing for the housing market going forward.
I agree. And if there was only 1.5 million homes built, that's still way too short. I saw a report recently along the lines of we need to be adding over 2 million houses in the next 10 years, every single year, to
Yeah.
even get our housing supply back to what we would consider a normal housing market. So I feel like it's going to take a long time to really catch up and make that a reality, because especially now, it costs more to build a home. People are going to be less incentivized to build that new home if the cost is higher. And, that still pushes up the demand for existing product.
Yeah. I think, I'll just say this. The notion that we need to be building 2 million homes a year, I have not found to be true when I analyze data and look at home building compared to job growth and population growth. Most of those narratives surround a study done by the National Association of Realtors last year that said we were 5 million homes short. If you read that study, you realize very quickly all they did was look at how many homes were built the last 20 to 30 years. They didn't consider, for instance, population growth has plummeted in America since then. And so I would say I think that sounds high to me. I think it's reasonable to expect that in certain markets, certain cities, we've significantly underbuilt over the last 10 to 15 years, but I wouldn't say that nationally, particularly in a place like Austin or Nashville or Dallas or Phoenix. We've been pumping out homes there for a while, but maybe in a market like Miami, you could make the argument we are really short because home building has never returned in Miami to the level it was 20, 25 years ago. So potentially you can make an argument, I think, in cities like that.
Yeah, and the thing is here, working in real estate here for the past 13 years, we were always a city that had excess inventory. We always had
Mm,
too much. We used to have anywhere between a year and a year and a half worth of inventory, which always made it a buyer's market forever. And now that has completely shifted to us having anywhere between 4 to 6 months at best. And that's not normal for Miami. And the
sure.
thing is, like a city like here, we're kind of out of space. Like we're surrounded by water here all of
Right.
the usable land has been built up. Where else are they going to build? Where are they going to put these new homes? There's really nowhere left to go.
It's a great point, and for that reason, I feel pretty. If I had to like pick a market in Florida I was most bullish on, it would be Miami for that reason. Like the single family permitting is very low as a relative to the population and job growth. It's funny because other markets in Florida, like if you go to Southwest Florida, it's the exact opposite situation in Naples and Sarasota and
Yes.
Fort Myers. They're just churning out new homes, like at the same way they were in 05, 06, 07. So that's just an interesting contrast. But yeah, I agree with you regarding Miami.
Yeah, it's going to be interesting to see how all this plays out for sure. All right, let's get into the next one. I have, so I think the demand to buy will still continue to rise due to higher rent prices. So I think that because the rent prices are going up right alongside of the housing prices, people are going to be doing that analysis more than before. They're going to be looking at, well, if I'm looking at paying $2,500 a month in rent, but I can get into this house at $2,300, it's kind of a no-brainer to get into that. Obviously, you have the restrictions that come with home ownership. Maybe you can't move as often. You have to make sure the numbers work if you need to rent it or if you have to sell it in a pinch. So I think a lot of people are going to be maybe considering that, who were always renters before, because either they like the flexibility or it was just cheaper.
Sure. Would you happen to be one of those people?
I am one of those people.
Yeah. Well, personal experience often informs some of the best opinions. I feel like that's a reasonable take to have. I mean, rents have gone up a lot, specifically in a place like Florida.
Yeah.
So I'm sure a lot of people feel a bit more urgency to buy. One question I do have is the sustainability of the rent increases. And this is an interesting thing because we've actually really never seen like rent go down in America. Like even in the last housing downturn in the late 2000s, rent didn't go down by that much. Like it went down by 3% or 4%, like nowhere close to how much prices went down. But at the same time, we've never seen rent go up by 30% in a year like we have in a place like Miami. And the question I have is like, what fundamentally is driving that? Because you take the pandemic, right? And we have 800,000 more people dead, and we have 3 million fewer people working, right, compared to 2 years ago. So I say to myself, what is fundamentally driving that rental rate increase? And I wonder if in the long run, if over the next 12 months, we're going to see it abate. But I think in the short term, you could be right. We see more people, fence sitters, I guess they call them, get into the market. But the question is, can they qualify for a loan?
That's a good
With the
one.
higher mortgage rates.
Absolutely.
What I remember I talked to you before. When did you make it down to Miami? What year was it?
That was 2008. So it was right as the market was crashing. And I got my real estate license at the beginning of 2009. Things were already at the bottom.
Amazing timing.
Yeah.
Back then, banks were obviously giving out loans very frivolously. I wonder whether they'll be tempted to do the same thing, given higher mortgage rates. I feel like that's the only way. Like, even if someone at the margin says, I want to buy now because my rent is higher. Like, well, the typical mortgage payment went up 32% in a year, which is insane.
It is insane.
That's insane. That's what you get with 20% price growth and then mortgage rates going from 2.8 to 3.6 or 3.7. Are they going to be able to qualify? That's kind of a big question I have. And so just to leave it open-ended, I don't know. What do you think?
Well, I think as a real estate agent, the only thing that might help people like that is maybe new loan products. Like I'm hearing about the possible 40-year mortgage making more of a splash in the mortgage market, which obviously you're taking on even longer term debt. Maybe that will help people's affordability. However, if the prices don't come down, I think that's still going to put a lot of those people in a pinch. And they're going to have to decide, are you going to want to rent a place that, maybe is nicer than what you could afford to buy and sacrifice, that
Yeah,
stability? Or would you rather have the stability and maybe buy something that might not be quite as ideal, but have the peace of mind knowing that you're not going to be kicked out in a year or your rent's going to
sure.
go up 50% next year?
Sure.
I see a lot of people like, okay, we have a lot of people moving here from out of state, just like you in Texas. And, that's driving the demand for rentals. And I remember in one of your recent videos that you mentioned how people have been afraid to list, right? They've been afraid to list their homes. And I think that translates over to rentals too, because imagine, you have a tenant there paying the rent, everything's been going fine. They're living there throughout the pandemic. The last thing a lot of people want to do still is maybe move and find a new place to live,
Sure.
given that all this is still going on and there's still uncertainty out there. So I think that also eats away more potential rental inventory. Then toss in the fact that more people are doing Airbnb and
Yeah.
things like that more than ever before. That eats up normal long-term rental inventory. Like when I first
Yeah.
started in real estate, there was no Airbnb. I mean, nobody was really doing that. There was like a few listings on the MLS that would do like short-term rentals, but that was it,
Yeah. I think it's a good point. So you're saying kind of at the margins, it's like here and there, the inventory is getting reduced. I think the Airbnb point's a good one, and it certainly is impacting certain markets more than others, right? Like I'm sure in Florida, that's huge. I'm sure in a lot of vacation and beach destinations. One thing though, and your point about people not wanting to move out of their rental and being scared to move out of their rental is also a good one. Again, I go back though to like that fundamental thought process of 800,000 fewer people, 3 million fewer jobs. And like one thing that happened during the pandemic, which I think people forget, is that the government policy during the pandemic was actually they did not want household crowding. They did not want people moving in with each other during the pandemic because that would spread the virus more. So
Yeah.
all of the government policy from the federal government in terms of eviction moratoriums, foreclosure moratoriums, even down to stimulus checks, was all meant to make sure that like people did not have to consolidate households. When normally, when we had all these job losses, you would have seen people move in with each other, move in with family, move in with friends, like all this other stuff. So that didn't happen during the pandemic, which pushed household formation up and took away vacant units. I wonder if in 2022, we're going to see that not necessarily collapse, but like the growth in households slows significantly, or maybe starts to go down as all of a sudden the realities of like, oh, you don't have a stimulus check now. You actually have to pay your rent. Like all these other things start occurring. Oh, and by the way, your rent's up 30%. Oh, maybe you should get a roommate now. Like we're going to see, I think, more of that occur in 2022. And so that could be something that maybe people aren't thinking about, but that had a big impact on why at least rental inventory is so low right now. Maybe that gets better this year.
Yeah. Well, let's hope so, because obviously people need a place to stay and, wages aren't going up enough to keep up with these rising prices. So we'll
That's
see.
for sure. That's for sure. All right, I'll get into my next prediction now. I think we're going to see price declines in 2022, like actually like price crashes in certain markets, but they're going to be primarily on the West Coast and in the mountain regions of America. So states like Colorado, Utah, Idaho, Washington, and California, potentially Nevada and Arizona as well. I think we're going to see it start there because these are the states and the cities where the prices, you do that analysis of how much people earn, what's the home price and the down payment, what's the mortgage payment. It's these areas on the West Coast that are just nuts. Like they're really bad. Some of them worse than they were in 06, 07 in terms of affordability relative to wages. And I think we're going to see the crash start there first, especially with higher mortgage rates. It's going to impact those markets. And we're already seeing inventory start to really go up in certain areas, Idaho in particular. And so that's where the crash is going to start. I think conversely, the Southeast is going to have another year of appreciation because just like the inventory is so low and there's still a relative affordability in the Southeast that even though prices have gone up a lot, it's not the same as it is in, say, a Denver or a Salt Lake or a Sacramento, where the local is just like completely priced out. And so I think we'll have price declines, western half of the US, Southeast, and potentially the Midwest still do okay in 2022.
What do you think about some of those other mountain states in that area, like Arizona, for example, that's been booming for a while, and maybe nearby Nevada? They seem to be kind of like the outliers in that.
Yeah, you're right. So they don't. When you look at the wages and the prices and the mortgage payments, Vegas and Phoenix, they're not good. They're not good. They're very expensive, but they're not as bad as Idaho, Denver, Idaho, Colorado, Utah, California. But here's the caveat: the investor demand in Phoenix specifically is insane. And 40% of the homes in Phoenix in the third quarter of 2021 were purchased by an investor. 2/5 of all the home sales were investors. That's getting to a level where, like, rather than, I think, helping the housing market in the long run, that's going to be a problem, because when you have that much investor demand, what happens if all of a sudden investors pick another market that they want to be in? Or what happens if rising interest rates tell those investors that maybe we should invest in a bond portfolio instead of real estate? That's a big problem for a market like Phoenix or Vegas, when a lot of the demand is from people who don't live there. And so I think the risks are a little different, but basically everywhere on the West Coast, I'm pretty scared if I'm a home buyer or real estate investor right now.
So you think that's where we should be paying attention to first right now? Watch for the dips over there, and then the rest could follow.
Yes, exactly.
Interesting. Yeah, well, I'll be watching it for sure, right along with you, because I'm curious to see it. Personally, being in the real estate business all this time, I think that this situation that we're in is just unbelievable, and it's kind of uncalled for. Obviously, the government stuck their hand in a lot of places it shouldn't have been in, and that's led us to where we are now. But I think that we're due for a crash. I think a crash ultimately will be good. When we see those markets starting to crash, and if it does translate over to other markets, that's only going to be a good thing in the long run. Nobody wants to take that initial hit, but it's something like the necessary growing pains that our country needs to go through to kind of get back to normal.
I think it's a great point. And I'm seeing this kind of in the comments to my YouTube videos on the Reventure Consulting YouTube channel. It's kind of like I'm seeing a lot of people who are existing homeowners saying to themselves, like, wait a minute, I have all this appreciation and equity, but like I can't actually do anything with it. Like it's almost like it's not helpful at this point to the housing market. And I just wonder if you were to, like, tell some existing homeowners, take a 15 to 20% write down on your value, but then inventory goes up and the other homes go down by 15 to 20%. Like, would you do that? I feel like a lot of people would actually say yes at this point, because, it's like, okay, I feel good with my appreciation, but I can't do anything with this. If I take a hit, inventory goes up and some other properties take a hit, maybe that's the better outcome. And so I agree with you. I think, some people on my channel, they say, oh, like, you talk about the crash, it's so fearful, but I don't think it's fearful. I think it's, like you said, it's going to be healthy to restore some balance to the housing market and get basically prices and mortgage payments closer to wages. I think everyone would say would be a good outcome.
Oh yeah, definitely. 100%. So my next prediction is, I think that home prices are going to continue to rise despite rising interest rates. And the reason I think that is because the supply is so low in a lot of places. This might change in some of the cities that you mentioned that are already going to have excess inventory that they didn't have maybe a few months ago. But anywhere where the inventory remains tight, I think even though the interest rates are going to go up, the demand is still going to be there, and people are still going to be after those homes. That's just a prediction. We don't know if that's going to happen, but that's what I think.
Yeah. And so basically, so that logic is basically saying that the assumption is, like, a lot of people is, home sales just went down heavily in December, right? But the logic, by 5% month over month. But the logic you're saying is they went down, but there's a lot of people waiting on the sidelines, and is that kind of what you're saying? And that if inventory goes up, they'll come in?
Yeah, I think that, say if you're living in an area and there's only 30 homes on the market right now, but then, if next month there's 45 and there's 15 new ones to choose from, and prices really haven't changed that much, but the interest rates have, I think those people, as long as they can still qualify to get that loan, they're still going to be interested in buying that house, even though it's going to cost them more per month. And that kind of goes back to the point I made earlier. If you're kind of considering, renting or buying, then that might be the biggest influence in that decision.
Yeah, it's almost like to me it's almost like a discussion of, can you find a home that you like? And in a low inventory situation, the answer is no. And so it's like you drop out of the market because I couldn't find a home that I like.
Right.
Yeah.
Exactly.
Yeah. I'm sure that's happening a lot. I mean, and actually you pointed out my video about how the new listings were down. I was shocked at the correlation between when the new listings dip and then inventory dips. And like, on one hand, that's logical, right? Fewer new listings to the market mean less inventory. But then it was almost like the new listings led the inventory, and that the demand kind of reacted to what the listings were. And that was kind of an interesting observation. So I think you might be right. In certain markets, there might be these fence sitters kind of who get back into the market when inventory goes up. Question is, what can they afford? Can they qualify? What are banks going to do? Which I think is an interesting thing to follow.
Yeah, and it probably also depends on how many of these people are going to be able to keep their remote work situation going as well. Like you have people like moving to Florida, for example, keeping their San Francisco salary. Well, obviously that gives you a huge unfair advantage compared
Yeah.
to somebody else, who living here and working here locally. And but if that goes away, that can change that dynamic as well.
Yeah, that's a great point. LinkedIn, I did a video on this a couple of months back, but LinkedIn came out with a study showing the share of remote work applications that came from different cities. And I want to say like Bend, Oregon, and Asheville, North Carolina, Asheville, not Nashville, Asheville were the highest remote work cities. I want to say it was like 40% of the jobs there were remote. And
Wow.
that's insane when you really think about it,
It
because
is.
if there is any remote work pullback, that's where those markets can get the rug just ripped out from under it very fast.
Absolutely.
I want to say what else was on that list. I want to say Orlando was on that list. There was a couple in Florida, but that's definitely something to watch going forward. I feel like everyone has their own take on remote work. Clearly, it's here in some capacity forever. But I think the big question is the hybrid model, going to be the path forward more so than the 100% full-time remote? And I don't know. I think it's going to be more the hybrid model. I don't know what your thoughts are on that.
Yeah, I think so too, because also, now that we've been doing this for probably 2 years now, basically, it's kind of taught us, what efficiencies there are to it, maybe some of the inefficiencies. So the hybrid model is probably the way to go, because a lot of companies that might have seen, well, this is either helpful for us or it's not, and they're going to make that decision accordingly. So I
Sure.
think it's going to be here to stay, but maybe not, in the capacity that we see it now.
Yeah. Yeah, I agree. Interestingly, like my second prediction here, second to last prediction, kind of relates to remote work a little bit too. And it's the area of the country that I think is the best place to buy in 2022. Like there's one area of the country I think is the best place to buy. I think history says this area is the best for investors in terms of cash flow. It's the most secure in terms of doesn't tend to have a big crash. And I also think it could be an area that if full-time remote work stays, the Midwest in America is going to stand to gain. And I think the Midwest is the best place for someone to buy right now who's really concerned with security, because this region of the country, cities like Columbus, Pittsburgh, you can even go into Buffalo or Indianapolis. I know you're from the Midwest originally, right? In
I am.
Illinois. These areas tend to have much more security and stability during a downturn. When you go back to the last housing crash from 2007 to 2012, when Phoenix went down by 60%, and Miami was down by 50, which I don't think is going to happen again. But when Florida and Arizona and California had these big reductions, Pittsburgh was flat. Albany, New York was only down by 10%. Parts of Illinois only went down by 10%. And it's kind of the situation where people look over the Midwest. They say no one wants to live there. There's no job growth, which might be true in a certain way. But really what you want in a bubble, if you want to protect yourself, is to be in the place where no one else is looking, because these are the areas with less speculation, less volatility, fewer investors piling into a place like Pittsburgh, which means that there's going to be less of a chance that these investors all exit at once and that there's price declines. And I think while for 2021, let's say, Austin and Phoenix and Denver were like the remote work gainers, I think they're going to be the losers this year, because the whole idea of 100% remote work is that you can work from anywhere.
Right.
And if Austin's too expensive now, or Phoenix is too expensive, no one has to stay there. If they're a 100% remote worker, they can go to a Columbus, Ohio, which data from Redfin is already showing that Columbus is seeing a big increase in the amount of people searching for homes from out of metro. So that's my second prediction. I think the Midwest is a really underrated place to buy real estate. I think it's the best part of the country to buy real estate right now.
Well, I obviously have a lot to say about that.
Yeah, let's hear it.
You know, I wanted to get in on this one for sure, being from the Midwest. So I have a little story to tell about that. A few years ago, I was looking at buying a house back in Illinois as an investment property, not to move in, but as an investment. And I found some decent deals that cash flowed pretty nicely, actually. But I actually decided against investing there. And the number one reason was future appreciation.
Sure.
When I was looking at what these houses sold for 20 years ago versus what they're selling for now, the difference wasn't that much. And in some cases, there might have been hardly any difference. And my biggest concern as an investor moving into one of those markets is if I buy a house over there today for 130,000, which is obviously an amazing deal for a house in America now, what's it going to be worth in 20 years when I'm ready to sell it? Is it still going to be worth 130,000?
Sure.
Looking at inflation, I'm losing money. You know, that's kind of the issue I'm worried about with investing in those areas. And I feel like unless there's a big wave of people coming and doing that, because it's the last safe haven as far as, you know, potential future growth. And I'm not sure if people are going to be jumping on board with investing in those areas, maybe for that reason. At least that was the number one thing that scared me away.
Yeah.
But I think for people to live, like say if you want to relocate there for a remote work purpose, then it's fantastic because you can get a very cheap cost of living and obviously have a nice safe area to live in. But, you know, you just got to deal with the Midwest weathers.
Yeah, the cold weather.
Right.
I think, yeah. No, I mean, I think that's a great point. The one thing I would say, you're right. The appreciation in the Midwest isn't as good, which is part of the reason why it's more stable in a downturn. And this kind of gets more into market timing, which, look, I wouldn't necessarily suggest that anyone try to time the housing market. Very difficult. But if you were to kind of follow an investment strategy by looking at the price of the home to local wages in different markets, and if you said to yourself, well, in a housing downturn or a place where home prices in America, or when home prices in America are at even keel, to then go into like growth markets, like say in 2013, 2014, you piled into growth markets like Austin and Phoenix and Boise and Miami, you crushed it. Right? You obviously crushed it since then. But then you say to yourself, oh, there's a point in time when the value in those markets and the appreciation gets so high above the wages, which is, I think, where we are right now in many markets, that you say to yourself, well, it's not realistic anymore to expect much future appreciation. And then that's when, as an investor at least, you start looking more at the safe haven cash flow environments. And so one thing I always do, I have actually a newsletter that people who join my channel as a member, which is different than a subscriber, you can join as a member, they get access to this 50-page newsletter on the US housing market. And one data point I always talk about is that value to wages and earnings ratio. Very important to look at. When the price gets too high above the wages, you just run out of room for future appreciation. But in the Midwest, the price is much closer to wages, which is why it doesn't crash as much.
Yeah, that's a fabulous point. I think so too. You know, even like you said, the last downturn, you really didn't see, I checked that in my hometown, you didn't see prices go down very dramatically, even though a lot of other markets were losing 50, 60, 70%. So that's definitely a good point.
What was your hometown?
My hometown is a little place called Belvidere, Illinois. It's about 90 minutes west of Chicago.
All right. Can't say I've heard of it.
Yeah, most people haven't, you know.
Yeah.
If I say, you know, where I'm from, I usually just say the Chicago area, and then people know where that's at. So It's
Yeah.
just easier.
All right. What's your next prediction?
My next one is, if the economy starts to tank due to these higher interest rates that the Fed is doing, that they will actually back off on that and maybe lower rates again. And they said they were going to raise rates 4 times this year, and you're already showing it in your data that the mortgage rates are spiking. It's only January, but if this starts causing a recession or even a depression, I feel like they're going to back off on that in a heartbeat.
You might be right. I mean, that's a tough one. I guess, is that you say, I'm implicitly, it seems like you're saying, so the Fed has a dual mandate, right? Price stability and full employment. Seems like you're saying they're going to prioritize full employment over price stability.
Yeah, well, I think so, because the thing is, if they don't do that, right, then none of the politicians, they want to have any kind of major economic downturn on their watch. And I think that's one of the biggest problems that we have right now in our country. And, obviously it's what needs to happen, just like we were discussing earlier, that these crashes need to come in order for us to kind of get back to normal. And if they kind of backtrack on what they're saying they're going to do, if they don't follow through with these rate increases, then I'm afraid that we're never going to get out of the situation that we're in now, and it could just make it even worse than it already is.
Yeah, I think that's a great point. And it's certainly an outcome that could happen, right? It's like you say to yourself, we're already seeing the NASDAQ, tech stocks crash. Like that's happening as we speak. Maybe that goes in the stock market, and maybe you see home price dips in certain markets. Does the Fed come in and say at that point, ooh, enough's enough? Maybe inflation abates like somewhat. Like I think for that to happen, inflation would need to go down. Like as long as inflation stays in the 6 to 7% range, I can't see the Fed wavering from this current policy of, which should be the normal policy of tightening. Maybe if the inflation kind of like comes down to 3.5 or 4, maybe 4.5, maybe, yeah, I think maybe they say, all right, let's soften a little bit. I'll just throw one idea out here though. And that's like looking back at previous central bankers like Greenspan and Bernanke. What they said and did in 2001, first with the dot-com bubble, it was all about this is contained. They got out there, Greenspan got out there and acknowledged that, oh, the stocks are going down. But it was very much like, oh, this is contained, no big deal. Eventually they did cut rates, but that was like the thing. It wasn't so much, oh, we need to go into reverse to protect the stock market. It was like, oh, this isn't that big a deal. And then, of course, they said the exact same thing in the housing bubble of 05, 06. They acknowledged that certain housing markets were overvalued in a bubble and prices were going to go down, but they said it's contained. So I just wonder if Powell would end up doing the same thing. Maybe in 4 or 5 months, he like addresses the fact that the stock prices and the stock market's going down. There's a stock bubble, that there's a housing bubble in certain markets, but then he goes, don't worry about it. It's contained. And I think if this, a lot of it depends on the speed of which this occurs, right? And obviously this is all speculation, but
Sure.
I think it's important to remember what they did historically, because it wasn't always like an immediate reversal. It was trying to downplay what was going on as not that big a deal.
Yeah, I think so too. I mean, that's the only way they can kind of get away with it and make it look like what they're doing is the right thing. But I ultimately think the right thing is to raise those interest rates and get our economy back to normal. If the stock market has to suffer, then that's what needs to happen. It's just, it is what it is. We've gone too long into this cycle of never-ending bull markets with everything, and this can't be sustained. So they need to do something. So I hope that my prediction that I just mentioned doesn't come true.
Sure. No, I totally agree with you. I feel like it needs to happen as well. And look, inflation 6 to 7%. So rates need to go up, right? That's just the way it is.
And that 6 to 7% is just what they're telling us it is.
Sure. Could be higher in certain circumstances.
Absolutely.
All right. So you ready for my final prediction for the 2022 housing market?
I'm ready.
This is going to be, I was thinking a lot about this one. I feel like it's going to be pretty controversial. I feel like when I throw this out there, a lot of people on YouTube get angry. But I'm going to say this, and this is, even though certain cities are really testing me making this prediction, I'm going to say in 2022 that rural and suburban areas, which were obviously did the best over the last 2 years, I think they're going to start declining, and we're going to see urban areas have a comeback. Because the rural suburban story was all linked to remote work, right? And clearly it was legit. People wanted to have more space and they didn't have to go into the office. So rural areas boomed, suburban areas boomed everywhere, whether it's in Florida or New York, where my mom lives in upstate New York, there was a boom. But I think we got to start looking at fundamentals now. And when you look at the fundamentals of a suburban or rural area, they don't look great because on the one hand, there's way more home building in those locations because there's more space to build. And so if you have way more home building, it really puts the onus and the burden on that continued growth in demand. And if maybe like what I think happened is that over the last 2 years, we kind of just pulled forward some of the demand for people to move into the suburbs. We kind of just accelerated that from over a couple of years rather than added to it in aggregate. I think we're going to start to see rural and suburban areas suffer as maybe certain people return to the office, as there's a lot more home building and home completions in those areas. And so I would say don't necessarily bank on that pandemic narrative of suburban rural locations continuing to do well. I think they can be some of the first to crash, whereas urban areas in the South, I think will do okay. Maybe not so much in places like New York and LA.
Yeah, I think that's a great point, Nick, because I would also say that people who are in those situations that maybe did move to one of those locations, more rural, the suburbs, they got away from the city, there's always going to be also a percentage of them that maybe they want to go back to the office, right? Maybe they want to go back to the city. They're kind of bored with the suburban life. It's not really what they imagined it would be, and they miss that hustle and bustle of the city, and that's going to play on that too.
It's like, oh, I got to be home with my kids all day. Are you kidding me?
Exactly. They might be missing that, high-rise office in the city and working late nights or whatever, Everybody's different when it comes to that.
Yeah, and I think it goes to like understanding that human nature didn't just change all of a sudden in 2 years. Like clearly, maybe some of the things with work and professional life changed, but humans didn't change. I mean, like humans still like social interaction and diversity and doing different things. And so I think you're right. That's a good point. We could see maybe some people reverse their exodus or their decision.
Yeah, absolutely. Well, getting into my final prediction, I think that there probably won't be a crash, at least not in 2022. And the reason I think that is because we still have a ton of demand, low inventory, and if that persists throughout 2022, I think those are the only two things that are going to keep us afloat regardless of anything else. As long as those two factors remain true, there won't be a crash.
Yeah, I mean, look, I think in my 2022 housing market predictions, I said aggregate home prices in 2022 are flat in America. And so I think it's certainly reasonable to say that across America on average, we're not going to see a devastating crash in 2022. But I think it's reasonable to say we're going to see variation around that, and that certain pockets are going to go down. I think that demand component, like I'd like to see defined more clearly, because I see so many people just say, oh, there's so much demand. But like, what does that mean? Because there's separate points. Inventory being low and then saying there's so much demand are separate points, right? Because inventory being low, so we talked about, it's primarily a listing issue. Primarily, demand influences it somewhat, but I think a lot of people are assuming there's this army of buyers that's just going to be there when inventory comes back. And I'm skeptical because that mortgage rate increase is immediately going to push a large swath of renters out of the market. That first-time buyer component, which is already pretty low. 26% first-time home buyers, I believe, was the most recent data from the NAR, lowest ever. And so, if mortgage payments are up 30% and their wages are up 8 or 5, they might want to come back in the market, but maybe they're not going to be allowed back in the market. And so that and then the investor piece. Because if basically the first-time home buyer share started plummeting middle of 2021. And then that was when the investors really came in to kind of take over that demand segment. I don't know. I feel like both of those segments are at major risk of not coming back into the market with higher rates. And so, obviously that's just my opinion, but obviously we're going to see over the next 3 or 4 months. But I think it's reasonable to say there's not going to be a massive price crash in aggregate in 2022.
Yeah, and I remember in one of your videos also you said that this is not going to be an overnight crash, and they never is. Even if you look back into the 2008, 2009 crash, it wasn't overnight. Prices started dipping month after month after month until it hit rock bottom, and nobody knew when the bottom was until it already happened and it was going back up. So it's kind of one of those things that catches you by surprise, especially if you're not paying attention. And whenever the market's crashing and you don't know about it, you're probably already too late.
That's an interesting point, is the psychology. And, I'm curious about what your perspective was in Miami, because around that time in 08, 09, 2010, because I think a lot of people have the perception that a crash is going to be like a housing crash is going to be like when a stock crashes and it happens in a matter of months, or it's going to be this huge fanfare event.
Right.
But it sounds like what you're saying is when it happens, it's not like that exactly. It's almost this kind of slow, just burn.
Yeah. And the other thing that's different this time is we probably aren't going to see this massive wave of foreclosures hitting the market like last time as well, which, back to what you said a minute ago, is the listing inventory. It maybe isn't that we have more demand than usual, it's that we just have way less inventory than usual. So the demand that is there, eats up that inventory like crazy.
Yeah, that's a great point. We haven't talked about yet was the foreclosure ban, right? For 18 months, banks weren't allowed to foreclose. And it's funny because basically the Biden administration, or I guess I believe the Supreme Court shot down the eviction moratorium, but that happened in August or September. But the Biden administration slid in another rule through the Consumer Finance and Protection Bureau that said that you couldn't foreclose until 2022. And so it kicked the can even more. There's 1 million seriously delinquent loans right now, which is a lot. That's a lot. Normally there's 400,000, right? Because we had all these people during the pandemic, and that's gotten better, but that's a lot of seriously delinquent loans. Going to be interesting to see how that filters through the market.
Yes.
Because maybe it's not so much a traditional foreclosure because these people have so much equity, but maybe the bank is like, hey, you just have to sell your home and pay off our loan. And so I think maybe that's the more likely result we're going to see. It's not necessarily a wave of foreclosures, but there could be a wave of listings that come from these seriously delinquent loans, which, to be honest, will be beneficial one way or the other for the housing
agree.
market.
It definitely will be. We need those listings. We need those listings to get this housing market back on track, really. And, it won't be a wave because not everybody's going to get foreclosed on at once. And the foreclosure process is quite a long one, and even longer in some states, depending on where you live. And they don't just all come on the market all at once. And I remember back when all this was going on, we actually had way more short sales here in Miami than we had foreclosures, because people were trying to work with the banks and at least have somewhat of a savior on their credit, because that way, it's not as bad as having a
foreclosure.
Right.
How long does a foreclosure take in Florida?
Well, back then it was taking up to 2 years because everything was backlogged so much. There were so many foreclosures in the system. But now I would imagine, since we hardly have any foreclosures, it could go through in a matter of months.
Yeah, that's very interesting. One little side fact about that last housing crash and the foreclosures is a lot of people say that it was the U.S. government and Fannie Mae that contributed to that foreclosure situation because they bought all the bad loans. But in fact, they also instituted a foreclosure moratorium back then as well, which people forget. The reason that it didn't work was because so many of the loans were sold in what's called private label securities the bank, rather than selling it to Fannie Mae, sold it to some Wall Street bank who packaged it up and sold it. And so that was one of the reasons why the foreclosure mess was so bad. It actually wasn't Fannie Mae bought loans. It was loans that were just sold into Wall Street credit default swaps, which I think is just an interesting thing to add, because a lot of people misconstrue what happened with those foreclosures last time. And so, yeah, I agree. I don't think it's going to be a wave of foreclosures, but I think we could see the listings one way or the other happen pretty quickly.
Well, I hope we do. Between people deciding to list out of short sale or foreclosure, or saying, hey, I feel more comfortable now, the pandemic is kind of dying down, I'm ready to list, I think that will be a good thing. So I personally am looking forward to that here in 2022.
We need it.
We need it. So what do you think about taking a few questions?
Let's do it.
All right, maybe we can take a few minutes and answer any of your questions out there. So I'll look for the nearest one. Anybody out there listening, just type in your question and we'll try to get to it here in the next couple of minutes. So let's see. I see lots of comments, but not too many questions.
Oh, what are the comments? Hopefully positive.
Oh, I got one of my biggest fans here, Jeannie. She says that I definitely know people who want and need to work at the office. I'm one of them. I have to, and I'm okay with it. There are people who want to go in though, and to get away from home. So maybe it's kind of a split situation there with people who are coming to the office, and some of them probably want to be there and probably some of them don't.
Yeah. I think it's a good point about people's preferences. The other thing I'm thinking about with remote work is, with the 100% remote, it's kind of interesting when you think about it from the angle of a company, because basically if you're proving to your company, if you do 100% remote, that your job can be done from anywhere. That's what you're proving to your company. So what's the next logical step? It's for that job to be outsourced to a different country at a much lower rate of pay. And I think that's an angle on this I don't think a lot of people are thinking about, is that a lot of people who've delved into remote work overnight, especially if they have roles that are like potentially offshoreable and replaceable, like by someone working in another country, non-client facing, for instance, that job can get outsourced. You're telling your company that job could be in India or Ukraine. And I wouldn't be surprised if we see that over the next couple of years, that a lot of these remote work jobs, if they don't come back into the office, maybe they go to another country, unfortunately.
Well, I would say if that does happen, then the companies that are doing that are definitely steering us in the wrong direction, because basically, we need those jobs here in our country. And the more they start outsourcing things like that, then the more trouble we're going to be in, like we're in now.
Sure.
Well, I have a couple of questions here. Somebody asks, what are your interest rate projections for 2022?
It's a great question. I'm not, I realized I'm not the best interest rate projector, because in my predictions video, which you all should check out on YouTube, I projected 4% by the end of 2022. Feels like we're going to be at 4% maybe by the end of January. I don't know. So, it's really tough to project. But it's funny. I did a poll on my community board here on YouTube, and I asked people, what do you think the mortgage rate is going to be at the end of 2022? And I think the median answer, like the one people answered most, was 5.5, or like 5, maybe it was 5%. And I remember being like blown away. I was like, no way is it going to be 5%. But then, I don't know, maybe wisdom of the crowds is right. And maybe it's going to be somewhere like that at the end of the year. Of course, depending on Fed policy.
Do you think that's a too high or too low of a prediction?
At the time, I thought it was too high, because I said there's no way it would be up to 5. But I think that's looking more realistic. And if it gets to 5, I mean, that's going to be curtains on a lot of housing markets right there, in a good way. It's going to be curtains on today's prices.
Yes.
It's going to be curtains on today's prices, and it's going to push people to sell, because they're going to be like, oh, damn, I need to sell before I lose value, and inventory is going to go up. So I think, 5% maybe would be my revised prediction, maybe 4.5, somewhere in that range.
Yeah, well, that's probably pretty accurate because I was looking at some of the transactions I closed back in that time period at what the interest rates people were paying on their loan paperwork, and a lot of them were in the mid fives, is around 5.5, 5.6%. And thinking of that rate now sounds kind of unbelievable, but back in 2010, that's what they were.
Yeah. And I think the important thing for people to remember on mortgage rates is it's not just the rate itself, it's the rate in relation to the price, right? Because I see some people say, oh, 4% is nothing. It was 12% in the 80s. And they say that as if it's not a big deal that it goes to 4, but it's really the rate in relation to the price. And when you have prices go up by 20%, and then you have rates go from 3 to 4, 4.5, that is a massive increase.
Yes,
That combination. So it's always important to remember that. Think of the rate in relation to the value and the price of the home.
yeah, absolutely. That's a really good point, Nick. And here's another one. Why are people fleeing the blue states and relocating to the red states?
Amazing question. I've done several videos on this with mixed reaction, but that is a trend that's objectively accurate. When you look at migration trends and job growth trends by voting and how states and counties vote, Republican areas, red states are gaining more people than blue states. We're seeing it in the Electoral College as well. Red states gained 6 net electoral votes. As far as why that's happening, I think in the long run, it's affordability driven, right? Cheaper homes, cheaper rent, especially compared to wages is really, I think, a primary driving force. But clearly over the last 18 months, you can't forget politics and some of the really, I think, draconian measures taken by certain blue states in terms of infringing on people's rights and freedom is clearly driving certain people to red states. I was one of them. I moved to Texas to get away from lockdowns. So I think that is definitely happening. The interesting question is this: will it continue? Are we going to see, or did we pass the peak already of that type of migration? That's a question I have on my mind, because if you look historically at migration trends, they're very cyclical. And actually, the amount of people moving to, say, Florida and Texas and Arizona right now is the same or less than it was in 05, 06.
Yeah.
Which a lot of people forget. Way more people were moving to Phoenix and Vegas back then than they are now. And so I do wonder, have we passed the peak of that, or are we going to see another year or two of this flight from blue states? I think we might see it for another year.
Yeah, I think so. Probably through the end of the year, as long as these states keep these policies in place that are pushing people here, then that's as long as we're going to see it for. But I think at probably some point throughout this year that those states might wake up and say, "Hey, what we're doing is not working. We're losing too many people. Our local economy's tanking from this. We're going to have to rethink what we're doing."
I think it's a great point. What would, I think, more than anything wake these areas up? A housing downturn.
Yeah.
Because all of a sudden, I see people comment on my videos. I'm pretty critical of California sometimes. People comment on my videos in California. They say, "Oh, it's good. There's too many." They say, "Oh, it's too many people in California, so it's good that people are leaving." Different calculus all of a sudden when the value of your home goes down by 25%.
Yeah.
You don't necessarily view people leaving as good anymore. And so I actually think that's actually the benefit of something like a housing crash or an economic downturn. Sometimes it can reorder the priorities in a positive way.
Yeah. People start feeling it in their pockets and might change things, turn it around.
Yeah.
Here's another good one, Nick. Beata asked, and thanks for the super chat, Beata. She says, my question is, when will the Florida bubble pop? That must happen eventually.
Yeah. That's a great question.
Yeah.
I think,
Go ahead.
no, well, actually, what were you going to say, Michael? I'm just curious about your opinion. I mean, you're on the ground there.
Yeah. Well, it did pop before, so it can definitely happen again. And Florida is largely driven by second home buyers, and we are also driven by people relocating here now because of these policies that we just talked about. But then also, there's always been the retiree population here, and that's something that is always changing because retirees come, they don't live forever, and then eventually they die, and those houses need to be sold. So Florida in particular could probably see more listings come on the market in the next 5 years or so than some of these other states that are experiencing these booms because of that reason.
I think that's a great point. And I think Florida's bubble pop is going to be different this time than it was last time. Last time it was very like severe, it was like 50% in certain markets, which I don't think is going to happen this time. But I
Yeah.
think in particular, it's going to be even more of a slow burn because for the reason you said, demographically speaking, in 2021, 50,000 more people died than were born in Florida, according to US Census estimates. And so I think what that suggests is your point is that as people age, we're going to see just naturally more inventory spring up in certain Florida housing markets. So I don't know if I necessarily see like a massive crash coming Florida's way this time, but I think it'll more be like we're going to just hit a peak and we're going to see prices maybe edge down a little bit, and then just kind of stay flat for a while, maybe over a decade. I think that's a more likely outcome.
Yeah, I think so too, especially, being boots on the ground here. That was kind of already happening pre-pandemic. Looking at like Miami, for an example, we had a big bull market run from, let's say, 2011 until the end of 2017. And then as 2018 came, prices were already hitting the bubble prices from before, from the 2008 and 2009 crash. And then it kind of slowly started to dip because people are realizing, well, this house now costs more than it did when it was at its all-time high. So obviously the pandemic has changed that, but I think it's going to be the same. Like you said, it's going to be a slow burn, and it's not going to be this massive pop like it was last time, because a lot of the factors that existed then don't exist now.
Yeah, that's a good point. What are your thoughts? I believe you might have done a video on this. What are your thoughts on the climate change discussion? Is that something people think about in Miami? Sea level, is that like a reasonable headwind in your opinion to the market?
I would say almost no one takes that into consideration, to be honest. I think that they probably should, but even I'm guilty in the sense that, okay, I make decisions based on today. Like, sure, we all know that this could happen in the future, but we don't know how soon it's going to happen. It could happen in 20 years, it could happen in 100 years, maybe it won't happen at all. We don't really know. Nobody can kind of see the future on that. And I would think more people might be concerned, especially if you're buying housing near the water here in Florida.
Yeah.
But you'd be amazed at how it almost never comes up.
That's interesting feedback. I'm kind of glad to hear that because I do feel like it is a lot of speculation and conjecture. What about flood insurance in Florida? I remember reading an article about 4 or 5 months ago about how the rates were just going nuts and like the flood insurance is more than property taxes or something like that.
Yeah, the flood insurance here is a real issue. I heard that recently they're going to be doing things differently now, where they're not going to be only taking into consideration the zone that you're in, but also maybe the history of claims in that area. So that might affect your flood insurance policy going forward. But
Is that supposed to make it cheaper?
it's supposed to make it cheaper, but I feel like it's one of those things that it can't be predicted, because people think, oh, if I don't live near the water, I don't need flood insurance. That's not true, because you get a torrential downpour here and your lot holds a lot of water, you can be flooded even if you don't live by the ocean or a river or a lake. So
That's a
you
great
know
point. It's a great point.
it's always one of those things that goes up. And the good thing is, though, like, say if you buy a condo, for example, and you're on the 10th floor, you don't need flood insurance. So it kind of depends on where you buy also. That's a huge factor in what you're going to be paying in flood insurance.
Could it be a strategy to say to yourself, if I'm in Miami, I'm going to buy 1 mile inland in the anticipation that in 50 years that's going to be oceanfront?
Well, some people are already doing that, actually.
Really?
There's a big movement right now from investors buying up property in Little Haiti, because apparently this is like the highest land mass in Miami. It's the highest land above sea level, and they're already buying up a lot of that land in anticipation for that. So obviously, there is speculation that one day this is going to happen, and that could be the new oceanfront. But
Interesting. That was a joke. It's just funny that people are actually already doing that.
I know, but think about it like this. Okay, if that is the new oceanfront and everything else around here is devastated, why would you even want that land? Because probably the economy here is going to be destroyed. So is it really going to matter by then? I don't know.
Yeah. And then quick question, Miami, hopefully hopefully we're not turning off people by just doing Miami specific. But is Wynwood in a bubble?
I think it is. Wynwood has become one of those places that literally 10 years ago, it was the ghetto. It kind of still is in the middle of the ghetto, to be honest. The neighborhood there can be very sketchy. You can walk, a couple blocks in the wrong direction and it's pretty bad over there. But, they have a bunch of new restaurants, there's new clubs, there's all kinds of art galleries. And especially if you don't know the area, you're just a visitor here, you just go there as a tourist, you don't know about that. And
Yeah.
it's kind of spurred demand for people from out of the area to be in that area because it's happening. But, if you don't know Miami, then you're unaware of that.
Yeah, it's funny because I looked at the poverty rates. So I have poverty rate by zip code data from the U.S. Census, and it's amazing how high the poverty rate in Wynwood still is. I believe it's around 30% of households are below the poverty line. And if you go back to the last crash and you isolate zip codes by two characteristics, number one is the poverty level high? And then number two, was there a big run up in appreciation in the bubble? Zip codes that had high poverty rate and run up of appreciation on average went down by 40%. Meanwhile, zip codes with low poverty rate and lower appreciation only went down by 10%. And so it's interesting because Wynwood sticks out to me as that type of place where the poverty rate's high, a lot of people still struggle, and the prices have gone nuts.
Yes.
And that kind of makes it an unstable. Just those characteristics make it an unstable submarket. So it's interesting to think about.
Yep. Well, we got another one here. This is an interesting one, I think. Curious on your thoughts on short-term rental purchases, maybe buying like an Airbnb property right now.
Yeah. I think you got to be careful because there is no supply constriction with that. Unless you're maybe in a specific city that has permits needed for Airbnb. You're in a market there where the supply can double of Airbnbs on the market. And so it doesn't have much of a moat. So you want to be careful. Check out a website called airdna.com. They have amazing data on rates and occupancies for VRBOs and Airbnbs by city. You'll learn a lot. They also show how the supply of the Airbnbs has changed over time. So you'll definitely want to educate yourself with data on that. Be wary of the lack of supply constriction. Also be wary of this. Lack of international travel since the pandemic kept a lot of travel domestic in America, right? A lot of Americans, rather than going on vacation to like Aruba or Paris, went to Savannah, Georgia, or Pensacola, Florida, or even Miami. As the world hopefully returns to normal with the pandemic, more people will begin traveling internationally again, which is not going to be good for the Airbnb market in America outside of major gateway cities. So if you're in a Pensacola or a Myrtle Beach or a place that like it's just getting mainly Americans traveling there, I would be very cautious because all of a sudden the demand can go down pretty quick.
That's a really good point. In fact, I didn't even think about that. So I'm glad you brought that up.
Yeah. But I think a gateway city is not going to be as bad. So Miami, I don't know exactly how Miami is going to shake out, but like New York would benefit from a return to international travel, right? Because people from all over the world are going to start going to New York again. But people from all over the world are not going to go to Savannah or Charleston.
Exactly. Yeah. Very good point. Good answer. So here's an interesting one. Any chances the COVID moratoriums are going to come back protecting tenants? Is it safe having tenants in Florida right now? I'll just debunk that one real quick and say that, we don't have eviction moratoriums anymore. We haven't for a long time. You can legally evict a tenant in Florida now for, I believe, already a year that's been possible. So I wouldn't be worried about becoming a landlord here in Florida at the moment. I don't know what the laws are in other states. Like, how are they doing it over there in Texas?
So Texas, you've been allowed to foreclose for, I think, also around a year. The foreclosures didn't pick up until more recently over the last 3 or 4 months. So it seems like there were certain landlords that, even though it was allowed, waited. So wouldn't be surprised if we see some more evictions trickle in 2022. But I would agree with your assessment. If I were a landlord, that wouldn't be like my highest risk factor that I'd be looking at. I think it's wise that you're thinking about it, but I would prioritize, as far as risk goes to you, I would prioritize like the yield and the rent you're getting compared to what you pay for the property, as well as how much new building of other rental and single family homes is in your market, because that's going to have a bigger influence on the likelihood of value declines and problems going forward. Also, you'd want to pay attention to the job losses in your market since the pandemic. Also, something I track in my newsletter on the Reventure Consulting YouTube channel. Yes, we have this like good job market right now, but like in certain markets, like Orlando's one of them. Orlando's job count today is 6 to 7% lower than it was before the pandemic, which is pretty bad.
Yeah.
And so that could be a hidden risk factor in certain markets. Now that the government stimulus is gone and the moratoriums are gone, are we going to see some of those job losses in a place like Orlando or Las Vegas start to creep into the housing market?
That's a really good point, Nick. And I would also say, if you're going to be looking at buying a rental property, you should also assess how many other similar rentals are available nearby, because obviously they could build more, like Nick said. But look right now, like if you're looking at buying a 3-bedroom house, for example, in a certain neighborhood, how many other houses are for rent around there at the moment? If there's not that many, then that could either mean, one, there's no demand, or it could also mean that there's so much demand that there's nothing available. But that's up to you to determine as the investor.
Sure. It's a good point. It's funny. One thing I would love to find, I don't know if it's on MLS, probably is, like understanding how rental listings in a market have changed over time. Is that something in MLS you could see?
What's that, Nick? Say that
Like
again.
to see how the number of rental listings on the market and rental inventory has changed over time, to say, well, on Miami, there's X% more or less active rental listings today than a year ago.
Yeah, absolutely, you can. I mean, you can actually go back and look at data. I think now with our new system, we have data up to like 8 years ago or so. So
Oh,
you can
wow.
go back and see what was on the market, what it rented for, the rental dates and all kinds of stuff like that.
That's great.
Yeah.
So yeah, I mean, I guess probably talk to a realtor and see if you can get that data to have a better understanding of, how the market's changed.
So here we got one. Do you have any input on the Tampa Bay market for 2022? Zillow put it as their number one.
Yeah,
I think this is a good question for you because you track so much data in so many cities that I'll be curious to know what you think about that.
it's a great question. I go back and forth on Tampa. On one hand, growth is legit. Migration, jobs, it's there. One of the top growth markets in America, objectively. No one can argue otherwise. On the other hand, they do build a lot of new homes, especially in some of those northern, like Pasco County in Tampa. There's lots of new homes, like kind of in the counties on the coast, just to the north of Hillsborough County. There's lots of new home building, which scares me, because I think a lot of those areas are kind of tertiary, and I could see some price declines coming. I think probably the safest place to be would probably Hillsborough County, the main one. That's actually pretty young. Median age there is like 37, compared to like Pinellas County and Clearwater. I want to say close to 50. So, I think Tampa's mixed. I think it will have a correction. I don't think it's going to be a 50% downturn like it is last time. But in general, I say if you want to protect yourself, stay to denser areas with a more youthful population. It will be harder for those areas to crash.
That's a really good point. Let's see. We got one more here.
All right, let's do
We'll
it.
do one more and then we'll wrap it up.
All right, sounds good.
Let's see. Just give me a second. Okay. Last question of the night, guys. Who is buying Zillow stock, or that's a bubble?
So I guess, what's the
Yeah.
question there? Should you buy Zillow stock or not?
Who is buying Zillow stock, Well, you got to remember with the stock market, guys, a lot of these companies will unload their own stock and then do buybacks in order to artificially inflate their share prices. And this is something a lot of the big companies do. So it's going to be hard to determine who's buying it, and I think that's something to watch out for if you're in the stock market in general.
It's a great point. Always a good idea to check what the insiders are doing. That's something you can do on if you just Google like Zillow insider trading, you can see what this like the CEO is doing and some of the other higher ups. Like for instance, one of the reasons I was actually all of these real estate technology stocks like Zillow, Redfin, and Opendoor have just plummeted over the last 6 months by 50% or so. One of the reasons I was keyed into Opendoor going down was I looked at the insider trading and I saw the CEO back in October, November was like selling a bunch of shares. And that's not an end all be all, clearly, but maybe it's something to look at if the CEO is selling shares. Maybe that's an additional data point to consider.
Yep, absolutely. Well,
All right.
anything else you want to wrap it up with here, Nick, before we go?
No, I just want to say thank you for having me on, Michael. This was great. I think it's just really important that people use data when trying to understand their housing market decisions in 2022, because there's so many narratives out there, like on home building and the housing shortage and millennial. There's like so many narratives that, like, when I look in the data, a lot of them aren't true. And I think, just really understanding the job growth in your market, the wage growth, how the prices compare to wages and what the mortgage payment relative to wages are, and then how many homes are being built. If you can really understand those things, you have a much better shot at making a more informed decision about like your home buying or investment purchase decision in 2022. On my channel, Reventure Consulting, I help people use data to make a more informed decision. So check me out, subscribe to the Reventure Consulting YouTube channel. And yeah, thanks again for having me on, Michael. This was great.
Absolutely, Nick. It was my pleasure. Definitely go check out Nick's channel. He's over at Reventure Consulting. Like he said, you guys won't find any better real estate data anywhere else on YouTube, I promise.
All right.
All right. Thank you for coming on, Nick. We'll talk to you again later.
Thanks, Michael.
All right. Take care.
All right.